Hi, I'm Kison Patel with Fundology. Today I'm here with Rich Beleutz, the CEO of Alternative Investment Resource, a Chicago-based boutique investment bank. How are you doing today, Rich?
I'm good. Thanks for the time, Kison.
Hey, Rich, if you just want to touch base a little bit about your bank and what kind of deals you guys focus on.
We're a Chicago-based boutique investment bank. We're a generalist, but if I look at our recent successful deal history, it's been in real estate, clean tech, energy, and medical device.
So you recently closed on a $50 million credit facility, and I wanted to learn a little bit more about that.
Okay. The facility was done for a firm called 540 Energy. They provide clean tech equipment to developers and projects. And we put together a facility specifically for LED lighting equipment for $50 million from a New York-based hedge fund.
Great. Now, how did you source this deal?
This deal was sourced through one of the members of our advisory board.
All right. So the advisory board member brought the deal to you. Then what happened?
So the advisory board member brought the deal to me in, about September of 2013. And so we met with them several times and finally engaged towards the end of November of 2013. And then we provided the funding at the end of February of 2014.
Okay.
Got a term sheet, got a verbal in December of 2013, term sheet in January of 2013. And then the deal finally funded thereafter.
So you meet with the owner, you go over, review his requirements, finalize an engagement letter, and from there, what was your process to find the lender and who exactly ended up doing the deal?
Well, this particular lender was a hedge fund that coincidentally had called me up in the fourth quarter looking for deals with government credit. This particular company had one of their clients who had a $75 million contract from the U.S. government to retrofit defense installations, army bases, prisons, etc., for LED lighting. And so we ended up financing that contract with that hedge fund who had reached out. It's a group that I've known for 5 years that we show deals to. So it was kind of one of these scenarios where we had a need for quick close, and we knew there was a demand. We knew the deal was not bankable yet, and so we went to an alternative lending source, a specialty finance hedge fund.
How was it negotiating with the hedge fund?
Negotiating with the hedge fund was fairly straightforward. They had certain covenants and requirements in the loan that simply due to the time frame we didn't have time to shop. So it was more a due diligence and a structuring exercise than it was a negotiation exercise. But they were great to work with.
What kind of terms did you end up with?
It was, I'll just kind of give you general terms here, but it was kind of low, teenish interest rate. They had some front-end fees, and they had some minimum loan requirements in terms of how much capital they needed to put out.
Was there a lot of back and forth to negotiate that part out, especially the paying a little higher interest rate for it?
There was some back and forth, but frankly, that was the easy part of the deal. There's some other nuances in terms of the speed, in terms of the fact that the hedge fund didn't want to finance our client. They wanted to finance our client's client. So it created some complexities in terms of our engagement and our mandate and the relationship between our client and their client. And, at the end of the day, we had some road bumps, and but we got it all worked out.
How was due diligence in the deal?
Due diligence was pretty straightforward. It was a little different because of the speed. We didn't have time to set up the usual data room and get all the due diligence nice and neat. It's one of these deals where it was ready, fire, aim. But luckily, we kind of knew where to go with the deal. So it was done kind of the old-fashioned way, with just delivering the information, kind of piecemeal and via email versus having pre-scrubbed diligence, pre-vetted and teed up in a data room, which is typically how we do it.
Do you think not having a virtual data room set up slowed down the process overall, or?
Certainly, it slowed down the process from the standpoint of we were waiting for information, which really, right towards the close of the deal. It really to lengthen out the close, which was, I know, very frustrating for our client and our client's client. However, because of the time pressure, it really wasn't feasible to do the typical, wait 30 to 45 days until we have all the data, because they just needed to know that they had somebody who was going to do the deal. So we had to basically get the hedge fund on the hook, so to speak, and we did that very, very quickly. But having to kind of go through and do the due diligence and kind of pull all those items together, during underwriting, basically did slow it down from what it typically would have taken had we, had, for example, they just said yes to our engagement in September, and we spent, November, October, November underwriting, and then went out to them. Then it would have closed very quickly.
Okay, great. How did the closing go?
The closing, went well. There was some challenges, like I mentioned, that we had to clean up post closing. So the closing occurred, and then there was a list, which is typical among specialty lenders, of post closing requirements. Because our client's client was a diligent operator who was very good at installing these retrofit LED lights and other clean tech equipment in these facilities, and that's really his life. And he didn't have a huge organization with a lot of support, and didn't have a CFO. What had happened is our client ended up taking on and we did take on a lot of responsibility for really just sifting through a lot of these post-closing items, even though, our client wasn't a fiduciary of this specific, transaction. So it's kind of a funky structure on how we got the deal done, and how our client positioned it with their client as a service. And, it took a little longer post-closing than typical, but, at the end of the day, we did cross the finish line.
Well, that's good. So as far as the transaction, were there particular key takeaways or lessons learned from this deal?
For us, I mean, there are lessons that, we've learned, certainly in this transaction that were unique to this transaction. Some things that we've learned in other transactions, but just, we consciously let repeat in this transaction. So the rush deal thing was something that we've dealt with before, so we kind of knew what we were walking into. But we felt we had a very, very high confidence that we could get, moving quickly and close the deal. We had a particular lender that was really keen. We had a strong relationship, was really keen on this type of transaction. So there's things, little nuances and things in how we would run through that. And a fire drill, again, it was, during the holidays, which, I was out of town for a few weeks due to some personal reasons, on a delayed honeymoon. And so my head of our investment banking group had to take the deal over. And, so some transference issues. There's the lender that wasn't going to work through the holiday. They pushed it past after the first of the year. The second thing was just in the structure, the fact that we ended up, financing our client's client directly, and it was a type of situation that we probably could have spent some more time setting expectations better. With that particular, borrower up front, that would have probably helped out in both the speed of getting the closing items together, as well as the efficiency and transparency in assembling the post-closing items. So, so there's things that, that we would coach our clients differently on, as well as things, in terms of expectations when we get to these scenarios where, and it happens, I want to say infrequently, but it does happen where we get into deals and we find out that the end credit, the end assets have a different entity ownership or an affiliated ownership that is a little different than our engagement. And so, a lot of times we ferret that out in our due diligence process, which we do heavy due diligence after the engagement.
Great. It sounds like things get easier with experience. After the deal, were there any other opportunities that spurred up from this transaction?
Well, it's a facility. So the credit facility, put out $2.7 million in the first transaction. It's a $50 million credit facility. They're required to put out $20 million. So they have, an additional $17.3 million that they're required to put out, over the first 12 months of the facility. We have another $4 million that's teed up and ready to go. That should be closing here in the next couple of weeks. So every few months or so there'll be a tranche, and the tranches will get bigger. So it'll be kind of a rolling close.
I want to know what kind of deals are you looking for?
Oh, in terms of deals, I'll tell you some of the types of deals that we're working on currently, and then that might give you a sense of the type of stuff that we like. We're doing a hospital roll-up right now. It's a $12 million EBITDA hospital, so it's a small hospital in the tertiary market. And they're rolling up a number of other hospitals, so there's a number of similar EBITDA transactions behind that kind of platform transaction. We have a Mexican aluminum smelting facility that we're setting up a specialty finance company for. We have a medical device company that's got a real innovative diagnostic, life sciences tool that sounds a little esoteric, but it's just so we work in different areas. For us, it's anything with good asset value or good credit, something that's post revenue or basically, where the revenue switch is, basically on autopilot and in motion is just pending. Those are the types of deals that we look at. Equity checks are typically between $5 to $50 million. So that's kind of the size equity we typically look at. We do a ton in real estate, and so I'll get to kind of we're generalists, so we do lots of stuff.
Well, great, Rich. I appreciate taking the time and sharing some insights on your recent deal with us, and look forward to hearing more about different deals.
Thanks, Kison.